if you haven't heard of the memo, we're an online tech publication. I'd recommend going online, checking us out, signing up to the newsletter. Today we're going to be talking about personal finance for the masses. There are lots of apps and services out there to help you spend your money. Whether it's Apple Pay or Amazon, it's very easy to spend your money today, but there's less apps that will help you save your money. So today we've got Ben from Moneybox and Ella from Scalable Capital. And these guys are building apps and services that will help you save money. Thanks. So Ben, first of all, how is Moneybox fixing people's finances?
So for those who don't know, Moneybox is a mobile app which helps people save money and invest for their future. I guess the way we think about it is that we're trying to make this easy, we're trying to make it engaging, and we're trying to make it accessible. So one of the ways that we make it easy is that we make it possible to open an ISA in a minute or two from your mobile phone. One of the ways that we make it engaging is that we have this concept of digital spare change, where you can round up the change from everyday card transactions straight into your ISA, so little and often. And one of the ways we make it accessible is that we allow people to get started with as little as £1. So kind of anyone can do it, anyone can get going.
Ella, same question to yourself. How is Scalable Capital fixing people's finances?
Yeah, so Scalable Capital is a new digital investment manager, so what the press has been calling a robo-advisor in the past. And what we're doing is we're trying to give retail investors access to an institutional grade investment product. And how we do this is by using technology in the way how we manage people's money. So we don't just provide them with a smooth onboarding process, but we use technology to basically target risk in a client's portfolio. So what that means is that when you sign up, you don't get offered a portfolio that's labeled conservative or medium risk or high risk, but we actually quantify the risk that is in a client's portfolio. So we measure risk with a risk number, which is called a value at risk, and a client can select a value at risk level between 3 and 25%. And then we look at that client's portfolio. Basically, every day we run a risk simulation into the future to assess how much risk is currently in that portfolio. And then if the risk exceeds the client's risk tolerance and the selected value at risk level, we will dynamically and automatically readjust it back to the original target level. So we basically don't care about the weights of different asset classes in the client's portfolio. We care about the actual loss risk, and that is a huge difference to how traditionally portfolios have been managed.
Thanks, Ella. As I said at the beginning, there's been lots of innovation around consumer spending, helping us to spend our money. There's been a lot less up until now around consumer saving, helping us to manage our finances better. Ben, why do you think traditional banks and FinTech players haven't been targeting this segment till now?
Well, I guess generally perhaps it's more exciting to spend money than save money, or at least historically it has been. And I think there's probably an opportunity to narrow that gap somewhat. We can make saving, we can make investing more engaging, more exciting. And why hasn't it happened? I mean, I don't know, these things go in waves and it takes time. So like buying stuff is now very easy on mobile, on web. And I think the whole service part, at least of the consumer space, is now happening. So whether that's booking a handyman, booking someone to mow your lawn, or someone that's more akin to a financial concierge, I think it'll come. I think it's kind of happening now, just with a bit of a lag to buying stuff.
I think it also has to do with trust a little bit. I think you need less trust to give someone £10 or even £100 to send to someone else, like for mobile payments, for example. But in our case, we have a minimum investment amount of £10,000, or in Germany, €10,000. And I think it actually takes a lot more trust, obviously, to basically give that money to a player that is right now not yet established in the market. So I think, obviously, the startups would go for sort of the lower-hanging fruit, where it's just easier to convince people to try out their service. And now we've basically reached that level of trust with the fintech industry and startups in general, that, you know, personal finance and investment is basically a product that people start to basically use, even if it's offered from a yet unknown company.
So, to both of you, whether you're saving a few pounds a week or saving £10,000 into scalable capital, traditional banks don't seem to have responded to consumers' desire to save more money. Ben, why aren't banks letting people manage their money easier and more simply?
I guess with banks and also with asset or wealth managers, there's kind of a good and a bad part to their business. So the good part is that they have a very, very sticky customer base. And in the short term, this protects them, a very low churn. I guess maybe long term, it's not such a good thing, because arguably it can mean the rate of innovation can be a bit slower than other consumer areas where customers can switch easier. So it can mean that, I mean, who knows, but perhaps it can mean that you have a full sense of security right now, and over time that can change. And I think the extent to which it changes in the next 5 or 10 years is just going to be a function of how quickly they choose to follow, are able to follow the very best innovations here.
I think banks also have the benefit that they have an incredibly loyal customer base usually. I mean, we discussed this earlier. Every one of us has some pain points with their banks, but, you know, we're not really thinking actively about switching banks because it feels to be such a pain. So I think banks, you know, won't see, you know, masses of people leaving them, you know, at any given day. So I think the need to innovate, I think they are starting to feel it right now, but it's not that they, you know, have, you know, customers fleeing in hordes basically. So, and then at the same time, I think, you know, established banks are very big institutions, and large institutions always struggle with innovation because they just don't have the organizational structure. Everything has to go through the steering committee, and, you know, all the expenses have to be approved, and then, you know, whatever the CEO is busy with another topic, and then, you know, your new, you know, incubator topic basically gets off the agenda for another 2 months, and in 2 months, some fintech companies have like semi-launched their product already. So I think it's just really, really difficult for large organizations to keep up with the speed with which fintechs are innovating right now.
Obviously, big banks have challenges, but I'm sure you guys, in building your businesses, have faced some challenges as well. What have been the challenges in building Moneybox and Scalable Capital up to now?
I guess there's some challenges which are common to a few different businesses, which are people, which I think is the most important thing, capital, which is also important, and I guess within finance, regulation. Probably the biggest challenge we've had is where we've had to integrate with old existing institutions, and again, well, I don't think it's easy for them, but they don't necessarily have a very high level of agility. So again, things can take a bit of time there.
So I agree with Ben. I think the integration work with other providers is quite challenging. And at Scalable, we tried to launch in 2 markets, in Germany and the UK, almost at the same time. So we're already live in Germany, and we just received FCA approval in February here in the UK. We're going to launch towards the end of this month, early May. And that is a huge challenge, obviously, also for your software engineering teams. And I think, in general, it's always a challenge to build a product that has absolutely awesome usability. And in our case, you know, an onboarding process that's completely paperless, completely online, very convenient. We had 2 apps for iOS and Android right from the start. Building all of that in-house is a huge challenge. I think in addition to that, I think you guys from Moneybox, you have the benefit that your product is very easy to understand. In our case, we're not offering a simplistic investment model that people have seen 100 times before. What we do is really new. We're the only digital investment manager that offers such a risk targeting product. So there is a little bit of an educational piece involved in there as well. So we invest a lot of time and money and resources to educate customers about what we're doing online, in videos, in the press, webinars, and so on and so forth. So I think that educational work will continue to be one of our main challenges, I think, going forward.
Both your businesses involve a financial education piece, whether it's teaching people how to manage those savings every week or teaching people about compound interest over years. Do you think Brits have poor personal financial education? And do you think schools and university education needs to do better at tackling this earlier on?
I guess it's all relative. I think in September 2014, personal finance became part of the national curriculum, so there's kind of baby steps there. I think the way we see it and the role we can play is that the best way for people to learn is to engage with these matters, to actually have it as part of their lives. And I think with many banks and wealth managers, they will often ignore people under 35 because they're not seen as particularly profitable customers. And I think what we hope to do with what is a structurally lower cost base and lower cost to serve is work with younger people from a much earlier age and engage with them. And in that engagement, they will learn about compound interest. They will learn the benefits of shares over holding cash in the long run. So I think we think that's the role that we can play in financial education.
I wouldn't say actually that Brits have a lower level of financial education or awareness about the products out there and how personal finance works than what you would see in other countries in Europe. So I have the direct comparison with Germany, and I mean you don't learn about that kind of stuff in school at all, and I think it is a problem because it's also a macroeconomic problem, as we know, all over Europe. People can't rely on the state to basically fund their retirement anymore, and people will have to save more and more on their own. And I think some people also confuse saving with investing. Just saving money does not mean that you're safe for retirement, because if you're just saving money, and I heard that in the Sunday Times, I think last weekend, they said that 80% of the money in the UK that goes into new ISAs every year goes into cash ISAs, but they typically don't even deliver a rate of return that keeps up with inflation. So people in real terms are actually losing money with those products. So they think that they are saving for their retirement, but what they actually need to do is they need to invest for their retirement. And I think the earlier people are aware of that, the better it is, because they could start at an early age as a student already using Moneybox's product, for example, to start saving money and then to also invest it. And I mean, if you invest for 10 years, between the ages of 25 and 34, you're actually going to have the same amount of money when you're 65 as if you're saving between 35 and 64. So 10 years of saving with investing afterwards, continuously, can actually give you the same retirement pot as investing for 30 years, much later on. So the sooner people start doing that, the better off we're all going to be as a society, basically, as a whole as well.
Last question to you both. I'm sure there are lots of entrepreneurs in the audience who are thinking about starting their own personal finance businesses. And I just wondered what advice you'd have for an entrepreneur today in this market.
Well, first, it's probably not too late to turn back, so you have that. I would say, spend time finding a co-founder with complementary skills, and that's both kind of soft skills and hard skills. And then I guess I'd have two thoughts which may sound a little contrasting. One is that once you commit to a business, you're in it for 3 years minimum, and those are 3 years of your life you can't get back, so make sure you want to be in it. So do your research. Two is that it's not always easy to kind of push yourself over the edge, and no matter how much research you do, you will never get 100%, you'll never get 95% certainty. So, do as much work as you can and then kind of push yourself a little. So.
Yeah, I would totally support everything that Ben just said. I think in addition, I think it's really important that you launch a product that's not just another Me Too product. So I read recently, for example, that there are dozens of robo-advisors in the queue right now with the FCA waiting to get their license. And I really wonder whether all of them will have a really unique product and will be able to differentiate themselves. Even though it's definitely not a first mover advantage industry or winner takes it all industry that we are in, and there's room for many more. I think you really need to think about, what makes my product really unique, because customers will be able to basically see that whether you offer something in addition to what others have been offering before.
Ben, Ella, thank you very much. Can we get a round of applause?